Retiring in a market crash could cost you 40% more in lifetime withdrawals than identical returns in a different order. And I'm not exaggerating. This is sequence of returns risk, and it's the number one wealth killer for retirees that nobody understands. Today, we're breaking down exactly why the order of your market returns matters more than people think, using real data from 2008, 2020, and 2022. Stick around, because this affects your retirement whether you retire tomorrow or in 10 years. Let me start with the shocking part. Imagine two investors. Both have $1 million portfolios. Both experience the exact same 30-year average returns. One retires in 2007. One retires in 2010. The person who retired in 2007, they hit the 2008 crash immediately, down 37%. They're now withdrawing $40,000 per year from a $630,000 portfolio. The 2010 retiree starts withdrawing from $1 million after the recovery. Same portfolio size, same annual withdrawal amount, same average returns over 30 years. By year 20, the 2007 retiree has withdrawn $100,000 more than the 2010 retiree. Same market, same returns, different order. That's sequence of returns risk. Here's why this happens. When you retire and start withdrawing 4% per year, you're selling stocks in a down market. That's forced selling at the worst time. You're locking in losses. Then when the market recovers, you're recovering on a smaller base because you've already withdrawn that money. It's not about timing the market. It's about the math of withdrawals during downturns. Let's go to 2008. The S&P 500 dropped 37% from peak to trough. Anyone who retired in 2006, 2007, or early 2008 immediately faced a choice: keep withdrawing and sell stocks at rock-bottom prices, or cut withdrawals and impact your lifestyle. Research from Morningstar and Vanguard shows that retirees who hit a bear market in their first 5 years had to reduce lifetime spending by 25 to 40% compared to retirees who started after the recovery. Not because they had less money eventually, because of when they took the withdrawals. Here's the math. Let's say you have $1 million and take 4% annually. Year 1, you withdraw $40,000. Down 37% in the market, your portfolio drops to $623,000. Year 2, the market bounces 26%. You're now at $785,000, but you're withdrawing another $40,000 because you locked in that 4% withdrawal rate. You're recovering from a lower base. Compare that to someone who retires after a crash. Same $1 million because they waited for the recovery. Market goes up 12, 15%, 18% for the first 5 years. Your withdrawal is still 4%, but you're taking it from a portfolio that's growing. The base gets bigger. When the inevitable correction comes, you're protected by years of gains. Now let's talk 2020. The COVID crash was vicious, down 34% in a month, but the recovery was fast, V-shaped. That actually reduced sequence risk for some retirees because the bounce back came quickly. But, and this is critical, retirees who had to liquidate in March 2020 still locked in massive losses. They sold their shares at 220s when they knew they'd recover to $280 by August. 2022 is the real killer case, down 18%. Fine. But 2023 wasn't a 40% up year. It was a slow grind. Retirees hitting 2022-2023 had to withdraw from a declining portfolio with a slow recovery. That's the worst-case sequence. Down, flat, down again, slow up. You keep withdrawing from a stunted base. Here are the numbers. A study by T. Rowe Price examined 10,000 different 30-year return sequences using actual market data. All sequences averaged 10% annual returns. The best sequence, highest returns first, allowed a retiree to withdraw $43,000 per year sustainably. The worst sequence, crashes first, allowed only $28,000 per year. Same 10% average, 40% less spending power. That's $450,000 less over 30 years. Now, you can't predict crashes. I'm not telling you to time the market. What I'm telling you is this: sequence of returns risk is real, it's quantifiable, and it's why your withdrawal strategy matters more than your asset allocation. So what do you actually do about this? First, understand the safe withdrawal rate isn't safe in the way most people think. The 4% rule assumes you can withdraw 4% of your starting portfolio annually adjusted for inflation and not run out of money in 30 years. But that rule was tested on historical data with different sequences. Some sequences failed, most didn't. But you can't pick which sequence you get. Second, build a cash buffer. Have 2 to 3 years of expenses in bonds or cash before you retire. If you need to withdraw and the market's down 30%, you're not selling stocks. You're pulling from cash. Your stock portfolio recovers while you live on the cash buffer. This is maybe the single most powerful tool against sequence risk. Third, consider dynamic withdrawals. Instead of withdrawing exactly 4% every year, adjust based on market performance. Market up 15%, withdraw 4.5%. Market down 15%, withdraw 3%. You're flexible. Your portfolio recovers faster. Fourth, be strategic about which accounts you withdraw from. Tax-advantaged accounts, taxable accounts, and Roth accounts have different tax implications. Withdrawing in the right order reduces taxes and gives your investments more time to recover. Fifth, delay Social Security if you can. Every year you wait, your benefit grows 8%. That guaranteed income reduces the pressure on your portfolio. If your portfolio's down and Social Security is covering your basics, you're not forced to sell at the worst time. Here's the bottom line. Sequence of returns risk isn't some theoretical concept. It's the reason retirees who started in 2007 had to cut spending, while retirees who started in 2010 lived comfortably. Same returns, different order, massive impact. If you're planning to retire in the next 5 to 10 years, stress test your plan. Use an online calculator. Crunchy numbers or new retirement are solid, and test your withdrawal strategy against 2008 and 2022 returns. See how your plan holds up. If you're already retired, review your asset location. Make sure you have that cash buffer. Make sure you're withdrawing from the right accounts in the right order. Sequence risk is silent. You don't see it coming until you're 4 years into retirement and the market's down 30% and you realize your spending plan assumes it'll bounce back next year. But it might not. Understand this risk. Plan for it. Protect yourself. If you found this valuable, subscribe to CashMind Daily. We break down financial concepts that actually impact your net worth. Budgeting strategies, debt payoff plans, investing mistakes,